Hello again from Sprott Money News at sprottmoney.com. It is now March of 2023. Geez, 17% of 2023 is already over with. And because it's March, it's time for your monthly precious metals projections. I'm your host, Craig Hemke, and joining us as usual is Chris Vermeulen of the technicaltraders.com. Chris, great to see you.
Hey, thanks for having me, Craig.
As always, it's always great fun to see you. You have such a valuable service. And I want you to tell everybody about that in a second, but I want to remind everybody, as we often do, this content is provided for free on whichever channel you're watching it, YouTube or Spotify, maybe listening on Spotify, whatever. If anything, help Sprott Money spread the word by giving them a like, maybe subscribe to their channel. The way those algorithms are built, the more subscribers you have, the more visibility you have. So help them out with a like or a subscribe, but then, hey, go to that website, as Chris is showing you. Anytime you're in the market to buy physical metal, which should be on a regular basis, buy some high, buy some low, got to keep Sprott Money in mind. Always great deals. Either buy it, hold it, store it. They can help you out. Again, sprottmoney.com. Or if you just want to pick up the phone, the number's right there on that homepage too, 888-861-0775. Chris, your work at the technicaltraders.com is an invaluable source of objective analysis here in 2023. Tell everybody what you do there.
Sure. Yeah. The Technical Traders, more or less, I cover the markets every week, just kind of like what you and I are doing, but on a little bit more of a granular level. We look at a lot of different sectors and commodities and asset classes. But more or less, I share everything that I do in my retirement account using ETFs. I share those trades, my insight with subscribers, and we all trade them together. And I focus on trying to generate the most consistent returns possible with the least amount of drawdowns or the smallest losses possible. And it's a pretty straightforward strategy. Everything is an end of day signal. So it doesn't matter how busy you are at the end of the day, in the evening, if we have a trade, we can put that on and it'll execute the next day at the opening bell. So it's a very passive yet active investment strategy, allowing us to profit from the market kind of gyrations, profit from rising and falling markets going forward. So that's a kind of the perk of being a technical trader. We can, doesn't matter if the trend's going up or down, we're able to take advantage of it just by using inverse ETFs and moving from different asset classes, from stocks to bonds to currencies, even cash. And just by rotating to whichever asset is performing best is kind of how we navigate this market. And sometimes cash is one of the best positions, which throws a lot of people off, but it is a very powerful position, especially with interest rates on the rise. So that's what I do.
Well, let's, as a generalist, let's talk about something that's on your radar. Give us something that you've noticed here as of late that is either an opportunity or maybe sending a signal that you want to make sure you notice.
Yeah, there's some interesting price going on in some different sectors. Obviously, we've had a lot of talk about the rates staying high and potentially going higher, and they don't really have a ceiling for the interest rates. Overseas, everybody's worried about rates continuing to climb. I even saw a news clip, I think yesterday, talking about in Europe somewhere, like grocery stores were something like inflation was 17% or something, which is just huge. But something that's standing out, obviously, if rates are going up, it's taking a toll more or less on certain sectors. And one of the sectors that's definitely taken a toll here has been the utility sector. And utility companies are generally carry a lot of debt, which means if rates go up, it's gonna cost them more to service that debt. And so utility companies, with all the talk in the past week and a half, 2 weeks of rates continuing to stay up or rise, we've seen utilities really fall off a cliff. And what I like about this chart is just look at the standout lows, very kind of cyclical, nice wave-like kind of cycles in the market. It looks and feels like utilities are getting close to a standout low here and are ready to have a strong bounce and rally. And I think a lot of people have been talking and thinking about the rates, and they've been dumping the utility shares. They've been dumping other asset classes like bonds, things like that. But I think all those that are rate sensitive are now getting oversold, and we might see a pretty good bounce going forward. So this is definitely a sector to keep your eyes peeled. The bounces in this sector are very strong, as you can see, big percentage-wise moves that can happen in a very short period of time.
I got to put my glasses on. How far back does that go in the lower left?
That is just 2021, April 2021.
Okay. I bet
So,
if you,
yeah, about 2 cycles per year in here. So
yeah,
yeah.
isn't that crazy? I bet if you extended that back on like a monthly chart, you'd probably see a lot of the same stuff. I remember back in my stockbroker days 30 years ago, a lot of people bought utilities as kind of a defensive measure, and they always paid a pretty healthy dividend. And so,
Yeah.
if just nominal rates are going up, then maybe that 5 or 6% dividend out of your local utility doesn't look so good. But if rates start going back down, then all of a sudden, not so bad.
Mm-hmm. Yeah, for sure.
Well, I think that's interesting that looks like, we're close to a bounce there again. That would, I guess, make you think, yeah, you know what, then maybe bonds are going to bounce and rates might at least stabilize, if not trend back lower on the longer end. What do you see? I know you use like the TLT as a proxy for the bond market. What do you see there?
Yeah, bonds are still struggling. I mean, if we zoom way back, or don't have to go that far back, just go back to the COVID spike in bonds.
Yeah.
Obviously, we're in a very strong downtrend. The grand scheme of things, bonds have, sold off, consolidated, another big sell-off, another consolidation. I feel like bonds might have actually put in a major bottom. I'm not sure if they're actually going to start making lower lows, but I definitely feel as though they could trade in this lower range here for a long time.
Yeah.
And it might be fairly dormant and build a base, a stage 1 bottoming formation. But overall, I think bonds are very similar to utilities, that everybody's priced in the rise in rates recently. Bonds have sold off, and they might continue to work themselves down. But I do think most of the downside on bonds has been already kind of evaporated over the past couple of years. And so now it's more of a waiting game. Let this big downtrend stall out, start to trade sideways. Eventually, if the stock market starts to fall apart, Fed will start cutting rates and bonds will put in the bottom, start to rally. So I think it's just a time thing. We're kind of in this big cycle between stocks and rates and all kinds of different kind of cycles at play here that we just need to let time mature. And I think it's going to take several months for all this to slowly unfold. But I think there'll be a great opportunity in bonds down the road to the upside.
And for everybody watching, remember, bond prices versus yields are kind of like a seesaw. As prices go down, yields go up. As prices of bonds go up, yields go down. And as we record this in early March, I mean, the yield on the 180-day or 6-month T-bill is like 5.2%. I referenced being a stockbroker 30 years ago. I mean, that used to be great. You'd think, oh man, I'll take as much of that as I can get. Just make 5% for 6 months, not have to jack around with the stock market. In 2023, however, it seems like there's still this momentum chasing and fear of missing out. And if you don't double your money in 6 months, you're a loser, that sort of thing. I wonder if, to support, the stabilization at some point here, there isn't a movement into bonds, all of a sudden a bid, and prices go back up and yields come back down because all of a sudden people go, you know what? Yeah, 5% for 6 months ain't bad.
It's not bad at all. I mean, considering the risk that we have, you and I have talked about this many times before, but if we look at where we are in this kind of this cycle of the stock market, I believe we're in this complacency phase for stocks. I still feel like we're going to have a big, major financial reset. The last time we had a reset like this, which is considered a stage 4 decline, was the 2001 phase where we got into that bear market. The 2008 financial crisis was also a stage 4, and we haven't had one since then. And so we're in this topping phase, and we're right up. Let me just go back down here. When it comes to stock market risk, we're right up at this nosebleed section. Maximum risk, investing money right now. You're really getting in near a top. There's a lot more downside potential than there is upside. And we really just need this market to cleanse itself and create that opportunity. And going back to your point, 5% in bonds and in different notes is a pretty, nice way to generate income with your capital protected when the market could collapse, 20, 40% from where we are if everything starts to fall apart. So it's definitely an opportunity, but I think people have the wrong mindset still. They're still in that hype, that momentum. They think they need to make 25, 50% a year. And that's not really the reality. I mean, maybe,
Right.
Options traders, short-term traders can try and do that, but it is a job. It is difficult. And to do that with your entire account, to have your entire account grow that much is you're pretty much always gambling and oversizing your positions to try to create that return. And it's a high risk play for sure.
I look at that chart, that one, or if you scroll back up to the other one that you started with, I look at that and I'd like, that looks like that TLT chart you just showed us, where it kind of flags a couple times all the way down, and now, I mean, that's interesting. Maybe the TLT is moving into stage one, and bond prices are about to bottom and rates are about to move back down. And again, you put that in terms of the stock market. Does there become a rotation, if you will, away from equities into bonds and the stability of bonds and that sort of thing? Could that cause an outflow of funds from equities, which kind of tips the whole thing over? Let's, if you don't mind, pull up a chart of SPX or a proxy for the stock market here in the US. There you go. I mean, wow. I mean, look how it just was just going and going and going higher with all the free money coming out of the Fed.
Yeah.
And now, then you had this clear, obvious to everyone trend line going down last year. It finally broke above there. It's always been my experience. You break a long-term trend line that was resistance. At some point, you pull back and test that line for support, which is about where we are now. How about, Chris, as you look at that, let's hit them both. How about a bullish scenario for equities, but then also a bearish scenario so that people have some things to watch over the course of the month?
Yeah. I mean, when we take a look at the upside for the SP 500, we could look at this a few different ways. The most conservative play will be to take this low using Fibonacci extension, taking this high and this pullback to the support trend line. So if the market can bounce in reverse here, I think we could see the stock market very quickly recover and get about a 10% move. It'll bring us pretty much right back up to this previous high over here. And that would be kind of the next leg to the upside. So there is some pretty good upside potential from where it is right now. The downside, I think if it was to break down, I think we'd go right back down to pretty much the double bottom here and see if it can find some traction. So, if that bottom is broken, then we'll really be breaking down into a stage 4 decline, which could get really ugly. But I mean, that's still quite a ways away. But right now, the market has pulled back to a support zone. And if we zoom into the most recent price action, right where we are here, the price action that we're getting over the last week, right in here, is very similar on a technical standpoint, market internals, what the market was doing right back over here as well. So all we need to see here, if this market is going to stabilize, work itself, and then take off just like we saw back over here. And we're starting to see that based on sentiment. People are getting very bearish. The put call ratio was over 1 yesterday. I think it's going to end up being fairly high again, probably this week. And that's just telling us that most people the majority of options are put options. People are betting to the downside and they're dumping stocks because they're worried. But when you look at it from a technical standpoint, hasn't really fully broken down. This is still a correction. It's still a series of higher lows. It's got higher highs. And the sentiment is here that we could get a very strong rally and catch a lot of people who are now short off guard. And that could power this move up. So it'll be interesting to see how that plays. But going back to your other point there before we touched on this, I think you're right in terms of eventually we could start to see yields or the interest rate stall out. They stop raising them. And then we see everybody start to move towards bonds, and then bonds start to rally. And then I think it's going to create like this stampede effect where everyone wanted to get out of bonds not that long ago. And now everybody's going to want to get back into bonds. And what was one of the worst assets, which was like TLT, the bond market is going to come back and rip everyone's face off with this massive rally. And everybody, it's just like a bathtub, the water sloshing back and forth. And if everybody starts moving to bonds to try to get that yield and to try and catch the move up in bonds, that money's got to come from somewhere, and they're going to move out of the stock market. So I do think eventually there's going to be like a stampede of people running into bonds and people dumping stocks. So there's definitely going to be a big tidal wave and some huge price swings in all asset classes, I think, this year.
Yeah, and I'm connecting some fundamental dots while you're speaking, Chris, and thinking about how everybody notes the inversion of the yield curve. The full curve's inverted now. If you go from a 3-month T-bill out to a 30-year long bond, it's more than 100 basis points. From the 2-year note to 10-year notes, about 90. That is always batting about 8 for 8 in predicting a recession. But oftentimes, the recession actually begins when that inversion begins to flatten back out. And what would drive something like that? Well, maybe a rally on the short end, where the 2-year note the yield comes back down. And what would drive that? Well, some buying of that short end U.S. government paper. And so you can kind of see how some of these dots connect, especially if we're right about the eventual recession that the Fed is leading the U.S. into. Anyway, that's neither here nor there. I just thought I would throw that on there as something to chew on.
It's interesting for sure.
We'll watch that. I wonder, you watch that 3,800 level in the S&P, or about 380 on the SPX. That would sure seem to be something to keep an eye on.
It will be for sure. I mean,
all right, brother.
I mean, we should touch on gold real quick.
Yeah, no, I think that's where we should go last. It's we sit here and kind of grind our teeth. I know I do. You look at gold. Oh wow, what a terrible month February was. Then you think, oh my gosh, the 10-year note went from 3.5% to over 4%. The dollar index rallied from below 101 to above 105. In some regards, I think, well, how is gold only down $100? Or you look back, Chris, drag that chart out to a year ago. We had, the real wild gyrations around the movement, what took place with the Ukraine war. But there's that area in that first third of 2022 where gold price is really around $1,800, $1,850. Look in January and February of 2022, if you could highlight that. Yeah. I mean, you take out that reaction with the war in Ukraine. If you go back earlier into February, or when the reaction gets worn off by April, we're talking about prices right here.
Yeah.
Now think of what has taken place in that 12 months. I mean, the 10-year note has gone from 1.5 to 4.5. The 2-year note's gone from 50 basis points to 5. The dollar index has gone from 90 to 110. I mean, all these crazy things, and yet gold has gone sideways through all of that. That's actually, to me, a rather telling sign. But anyway, no one wants to hear what I think. This is your show. What do you got
good points. I mean, I mean, gold's seen as that kind of global kind of safe haven. Like, when you look at, I mean, it's had some pretty big ranges through here over the past year and a half, 2 years. But you're right. I mean, after everything that's gone on, it's held its ground. It is right where it was before the war hit. And I memean, it's had a pretty strong pullback in the last month, simply because pretty much what the dollar has done. We've seen, if you look at this chart and these down red bars, if I click on the dollar, it's pretty much the inverse chart. And we've seen the dollar have, the exact move up. And so, the dollar could continue to rise here. If the stock market doesn't bounce and rally, I think we could see the dollar push higher. And we might see gold continue to pull back a little bit and struggle as the dollar rallies. And it's going to be interesting to see if gold and miners come back as a defensive safe haven play. Yesterday, what was it? It was on the March 1st, we saw gold miners post some pretty good gains, up to 3% for the GDXJ, showing us that, they still have a defensive play. When people get nervous, they pile into that sector. And I think they were doing very well late last year. I think they could come back in and do well again, the precious metals and the miners. And it's going to be interesting to see how they hold up. When we look at GDX, it's had a very nice strong bounce, kind of off a support zone. And I think we could see them come back and become a little bit of a leader. because they still seem to have that defensive play. It's just that dollar, that move in the dollar really took the wind out of the sails for a little bit. So it'll be interesting to see how that unfolds.
Well, you mentioned, what would catch a lot of people by surprise would be a sudden 10% rally in the S&P, which isn't out of the realm of possibility. Yeah. Just as it's not out of the realm of possibility to have it fall 10%, but it would sure catch people by surprise with the bearish sentiment. A rally in gold would catch a lot of people by surprise too, with all of the bearish sentiment. Just let's wrap up with that daily chart of gold. Is there a level you're watching that would be like, wow, if we, can hold above 1840, or if we can, move above a certain level, what would be one that would catch your eye and make you think, wow, this is looking better than I thought?
It's not too far away from potentially getting somewhere somewhat exciting. I just drew a line across this little bear flag here. These bars,
yeah,
it happens to be just above the 50-day moving average, which is this blue line. Also the 20-day moving average, and they're very, it looks like we're close. If we can get above those two moving averages, get above this high, that would be the first sign that gold is clearing a few levels where sellers are lurking. And if it can hold up above that level, which is around that 1860 would be a safe call, somewhere right there. I think that could be the sign that we're off to the races and we're going to see it move higher. So that's kind of a very short-term view, but definitely if we can get above and hold those for more than a day, we could very quickly, I think, see gold here probably rally back up to 1900, which is a whole number. Typically, I like to look at whole numbers because there's naturally going to be people saying, well, if I'm long, if it gets to 1900, I'm going to sell it. They just like whole numbers. Same with 2000 and anything like that. It's also a previous pivot high on this chart. So there's definitely going to be a level of resistance there. I mean, the 1920 area, which is where we had a big breakdown and a lot of bars trade and touch that low, that'll be the next kind of resistance area. So there's definitely kind of some short-term potential here. But you definitely need to be aware that sellers will step in at 1900, 1920. We could see a lot more volume step in and take the wind out of the sails short term.
Well, I like it. Let's keep an eye on 1860, everyone. From a fundamental standpoint, we've got the U.S. jobs report coming up on the 10th. The next Fed meeting comes in a week after that. There's a lot of news. What if the FOMC is not quite as hawkish as everybody thinks? Who knows? A lot of news that we got to digest during a very long month of March. And I think you've given everybody a lot to think about, Chris. So I very much appreciate it. And I know everybody appreciates you sharing your wisdom and your experience with all of us.
All right. Thanks.
And from all of us at Sprott Money, thanks for watching. Again, please keep Sprott Money in mind. There's the phone number right on that page, 888-861-0775. Keep them in mind and send them a thank you for putting this content out free of charge. Chris, we will talk to you again in April. I'm sure be curious to see how the charts look then.
Sounds good. All right. We'll take care.
And from all of us at Sprott Money, hey, thanks for watching. And keep an eye on this channel as we go through March for a lot more great content.